My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you a little money. My job is not just to entertain you, but to educate you, so call me at 1-800-743-CNBC. The darn thing? It just doesn't want to quit. After opening down 70 points in some real weak factory data, this unsinkable market proceeded to rally right back, with the Dow closing up 21 points, S&P rising 0.25%, and the Nasdaq gaining an astounding 0.66%. All right, how does it happen? Right? That's what you're thinking. How does it happen? How does this market rebound so swiftly like a stock version of Wilt Chamberlain? What makes it rally when it should stay down, play dead? I think the secret of this market is the immense negativity surrounding its every move up. Despite shattering record after record after record, everyone's afraid to give this market its due. The strength of the stock market, quite simply, is incredible. Consider just this one stat as evidence of what I'm telling you. The Dow has yet to have a 3-day losing streak during the 82 trading sessions we've had so far in 2013. Unfathomable. Do you know this is the first time in history, not 5 years, not 10 years, not 6 months, in history that the index has gone this far into the year without posting 3 consecutive losses? Think of the degree of difficulty that record smasher implies. It means we've had many days where, like today, various times, market looked weak, but buyers came in from somewhere, anywhere to buy stock. Still, no one comes forward to say this market's the real deal. It's as if we learned our lesson after the great bust of 2000 and 2007. Don't you ever say anything good about a market, ever, because you will just be labeled a cheerleader and ridiculed on national TV, perhaps on another network, if you applaud this market. And then it goes down. It's just not worth sticking your neck out. That's why the tenor of the last 24 hours is to emphasize, not debunk, but emphasize that today the calendar turns and tomorrow is the dreaded, scary May 1st. The day we are supposed to sell. It's like a bizarre celebration of two horrendous days for capitalists everywhere. May Day, a communist-inspired holiday where workers triumph over capital, and May Day, where we expect the whole edifice to sink. Now, it doesn't seem to matter that this is the 4th straight up month to start the year. A trick that the good folks at brokerage firm BTIG tell us has happened just a scant 18% of the time. It doesn't matter that when you have that setup, the market's rallied into the end of the year 14 out of 15 times. Again, incredible BTIG stat. Or how about this, that the average gain is an extraordinary 9% from here. Nor does it even seem to matter that May is just a coin flip month. Since 1950, there have been 35 instances where April was up 1%, and in 17 of those years, the Dow posted a gain of 1% in May. Hey, how about this one? Over the past 20 years, May's been positive 50% of the time, and we're supposed to sweat the program? Put all these stats together, and you can safely say that the best thing you can do if the market goes down in the month of May is to buy. Not sell. But that would be violative of the protocol of benign restraint that we must all practice, lest we be taunted for actually suggesting you own or buy stocks, and then the next day the market goes down. Now, it's not just the entire stock market that's been slammed with faint praise at best, as if this potential Hall of Famer market should be benched for poor performance. The most glaring source of negativity is none other than the one-time perma-uber bullish analysts who are now fighting the last war. The one that took the Dow from 14,000 down to 6,500 back in 2008, 2009. A real trouncing by the bears. Incredibly inked on these analysts' psyches. These big thinkers have been at the forefront of giving this market a bad name, and you don't have to look further than any, let's just say all you have to do is look at a one-time market darling. Yes, Apple, to see what I mean. Okay, here's a stock that after a horrendous $250 billion fall from grace, still didn't get the true wrath of the analyst community until it had dropped to $389 from $705 back in September of last year. Consider that after Apple's latest quarterly report last week, we got the following from these highly paid Wall Street prognosticators. First, BMO Capital just out and out capitulated at last, downgrading the stock from buy to hold, saying that despite the now 3% yield, which you know is where I begin to like any stock, the company reported such disappointing gross margins. Yeah, it was time to step away.
That was easy.
Step away from the stock even after its huge swoon. Or how about Goldman Sachs, which when Apple was flying high around its all-time high of $700 and change, Goldman took its price target from $790 to $810. What did Goldman do when Apple swooned to $406? They cut their price target from $575 to $500. Very useful. Now, I don't mean to just pick on Goldman. When Apple was flying high, Deutsche Bank raised its price target from $775 to $850. When it was laid low, Deutsche slashed its price target to $480. Same story with UBS. In the month that Apple went to its all-time high of $705, UBS raised its price target from $740 to $780. Then near the bottom, price target got slashed. $500. And what's happened since then? How about a 40-point rebound out of nowhere with the stock going from laggard to leader, closing today at $442 and change? I wonder, yes, and you're thinking it too, if those same analysts will start raising their price targets tomorrow. I have to tell you that while this Apple price target cut pattern is more egregious than most, we've seen analysts jump ship over and over and over at the least provocation. Consider that when Best Buy, the big retailer, was traveling on the way down from that hideous journey from 32 years ago to $11 in December of last year, it received an increasing amount of opprobrium as it approached that low, culminating in a crescendo of downgrades just when it reached a level that turned out to be a tremendous buying opportunity. Same with Netflix in the 70s, down from $297, only to see the stock triple soon after. And we got downgrade. Chipotle from $402 down to $294, which again turned out to be a fabulous time to buy. Stock has since vaulted $363. Oh, by the way, every one of those stocks I just mentioned, I think they could still go higher. Oh, of course, now I just put my neck in the noose. Now, I can't blame any of the analysts who cut price targets and downgraded these stocks at near the lows, because in each case it did seem as if the companies were on the ropes or had their prospects permanently dimmed. I mean, when you think about it, Apple, for example, had just disappointed for 4 straight quarters. So why stick by it? Just for the 3% yield, even though that yield has held for many a tech stock? I'm talking about an entire mindset here, though. A mindset of negativity dictated by analysts and prognosticators who freely believe that if you're positive, or if you stay positive in adverse situations, you're lightweight. And you're going to run the risk of looking too foolish, too happy, too optimistic. In a world where increasingly optimism seems sorely misplaced, and only pessimism is really taken seriously. There's simply no recognition that we have indeed taken out the highs. Instead, we hear that there's no real revenue growth out there, so don't trust those earnings. The earnings, how about the prices? Even as the earnings are so bountiful that they've allowed for monster buybacks and incredibly bountiful dividend boosts, we hear that any possibility of a bottom in Europe must be dismissed out of hand, even as companies are now beginning to say the opposite, particularly on this show. I'll point that out later. We understand that the budget deficit or the sequester has to lead to lower stock prices because we hate Washington, even though it's clearly not been the case. We fully expect the Federal Reserve to pull away from its bond buying program soon, and will parse every word from its open market committee statement tomorrow, looking for clues about how all of this must end. And of course, we dismissed any of the possibilities that May Day may not be a combination of a communist holiday and a call to abandon ship. Yes, the market and individual stocks have been doubted the whole way out. If you so much as say a good thing about this market, and then the next couple of days it goes down, you will be lambasted in 1,000 different venues, especially at Jim Cramer on Twitter. But if you just go negative and stay negative, there are no consequences whatsoever. So here's the bottom line. In a world where you can get skewered and trashed for being positive, but can only be applauded for being negative, is there any wonder why so many have missed these gains? Only the positive people are pilloried. So even though every bit of empirical evidence says don't bother to take that sell action, maybe we should, indeed, just mouth, sell in May, and, well, you get the picture. James in Pennsylvania. James.
Hello, Cramer. How are you?
I'm real good there, partner. How about you?
I'm fine. I'm calling to ask about Las Vegas Sands. I understand that their auditor has resigned, and I'm wondering, what is your outlook for Las Vegas Sands? Sell, buy, hold?
I take my cue from China, and a number of our CEOs that we've spoken to, both on the record and behind the scenes, have said that China has already bottomed, and you should stop paying attention to the minutia. That means you want to own LVS. But I have to tell you, I like Win more. Too legit to quit. As stock seer MC Hammer said, you know what? Stick with the market. Stick with Cramer.